Good afternoon and welcome to those of you joining us. We have quite a few people who have been waiting in the waiting room, so we'll give everyone a chance to get in. So if you're just joining us, welcome. We'll get started in just a minute. All right, several of you are coming in from the waiting room. Thank you for joining. A lot of you joined early. That's fantastic. This is a really exciting topic, so we're happy to have you this afternoon. Looks like people are still coming in a little bit. Okay, welcome. Welcome to our webinar this afternoon. We're so happy to have you. Okay, it looks like most of you are able to get in from the waiting room, so we're going to go ahead and get started right here on time. My name is Amanda Watson, and today we are going to be hosting a webinar for the One Big Beautiful Bill Act, Insights and Support for Tax Pros. We're really excited to offer this topic for you today. Our presenter today is Ann Campbell, and I'll let you know a little bit more about her in just a moment. But before we get started, while everyone gets settled in, I want to take just a few moments to go over a few key items. First, I would be happy to introduce myself. My name is Amanda Watson, and I've been with Drake Software since 2003. It's kind of hard to believe that, but I'll be here just hosting the webinar today and helping Ann answer some questions. But a few other important things that you may need to know. During today's presentation, we want to hear if you have questions, and we will be using the Q&A panel or the question and answer function. Right inside your Zoom application or screen, you should see a button that says Q&A. Use that for questions. Drop your questions in there. We'll try to get to as many questions as we can. Many of them we'll be able to type an answer to, and someone may be able to answer live during our presentation. The chat and some of the other features are disabled for this session. However, we will be providing information and links to you in the chat. So you can receive information in the chat, but if you have a question, use the Q&A. This webinar is being recorded, and you will receive via email a recording or a link to the recording tomorrow. So in about 24 hours, expect an email with a link to this presentation. I think it's important to know that today's presentation does not offer CPE or CE credits. However, we have so many options available if you're looking to earn education credits. We have Drake CPE and online software training, and we'll add all of those details and links in our chat today. So if you're interested in that, be sure and check out the links and information in our chat. Of course, we love hearing from you, and your feedback is essential. It's really how we operate here with a customer first mindset. So once the webinar is finished, you will receive a short survey and would be grateful if you could take a few moments to fill that out. And as we go along today, we will be adding additional details in the chat. So just a few things that we plan to cover today. Again, we are talking about the One Big Beautiful Bill Act, and we want to be sure and highlight a few agenda items. We are going to talk about the permanent extension of key items from the Tax Cuts and Jobs Act, including tax structures and brackets. We're going to talk about Form 1040 and some changes that you may not know about or may know about and want to know more about. We're going to discuss Schedule 1A, itemized and standard deductions, tax credits, Form 1099, DA, and of course more. And I can't think of anyone better to host this session than Miss Ann Campbell. She has done extensive research on all things One Big Beautiful Bill. And I would love to turn it over to Ann. And just remember, before we do, if you have a question, use the question and answer panel. And now, without further ado, welcome Ann Campbell.
Thank you, Amanda. And Amanda is, yeah, I can't believe it's been so many years, Amanda. It's like you're the face of Drake. But Amanda went on to, I think it's the onboarding and retention and some other things. And she's totally Miss Drake USA, as we say locally. My name is Ann Campbell. I am a CPA and also a CIA, which is a certified internal auditor. I do have industry experience. I have been speaking for Drake since 21. I do work for Drake, but I also have my own tax practice in California. So you'll hear me maybe hopefully give you some practical tips once in a while in my classes. And I am a graduate of the Wharton School. But let's get to the real reason that we all are here. So Public Law 11921, otherwise known as the One Big Beautiful Bill Act. But you may have heard this. We have OB1, OB2, and we refer to this new bill as OB3, just like a lot of other people do. So tongue in cheek there, but basically that is your way that you're going to hear me refer to it today. But it is the official HR one, et cetera. And that's not really that important other than you'll hear it, me talk about it as OB3. So some major provisions. The focus of today's class is more on the individual side, but we will have lots of classes in other places, like Amanda said, for the business stuff. We will sprinkle it in, and of course, in our update schools, we go over all kinds of things as well. But we have a couple provisions in this new act, permanent extension of tax rates and some other things that like QBI, et cetera. We'll talk about those. The Form 1040 is changing. Some of the changes actually surprised me a little bit. We have a brand new Schedule 1A, and that's where the tips, overtime, car loan interest, and senior deductions go. Gambling losses changed. I will mention that. Itemized and standard deductions. We won't dig in too much into the itemized. It's more the standard that's going to we're going to focus on, but we'll mention some of the itemized changes. And then there's a lot of little miscellaneous things. This bill was called the One Big Beautiful Bill Act for a reason. It covers a lot of things that almost have nothing to do with taxes. We will not talk about those today, but if you ever have time, you should really look at the entire bill. There's actually changes for things that you might be surprised at. Okay, so here is the draft 1040. I don't know if you're aware, but you can always go to the irs.gov site /drafts, and you can look at the draft forms as they are releasing them. Obviously, these are not final. However, it gives us a good idea of some of the things that the IRS is going to start focusing on. One of the big changes that me and others were surprised to see is the box on the very top, filed pursuant to section 301-9100-2. And there's check boxes for deceased or combat zone. And then there's an other box, which kind of is a mishmash. There's a box on the right-hand side for a check if your main home and your spouse is in the US for more than half of 2025. We all know that makes a difference in some of your tax treatment. And I just highlighted the dependent box. Notice that it is now columns, one for each dependent. And we will get into that a little bit later in detail. But the box for filed pursuant to section 301.9100-2, let's talk about that for a minute. It's too much material to cover in this class, but there are some extensions that are automatic. And if you file an amended return in general, you're going to want to check these boxes if you're using one of these exceptions for the automatic extensions to make some elections. If you need more detail, of course, just go and do the research. But some are 12-month, some are 6-month. And don't forget that this would basically be for amended returns. However, it may apply to a superseded return. So again, you can make a superseded return up to the extended due date of the original return as long as there's a valid extension. And usually with a superseded return, you do not need to, you're replacing the original return that you filed. It is different than an amended. So just make sure if you do check this box on the 1040, you know exactly what you're doing. And again, it's a little beyond the scope of this class, but this is a brand new box. The other things in this area, the deceased with its or the the deceased for the taxpayer or deceased for the spouse. It used to be that we kind of put that in the name field. I think what the IRS is doing with some of these changes they're making is they are coding it so that it won't be something that has to be looked at by a person as much. So I'm starting to see a lot of boxes that are checked or not checked depending on the situation. And this is one of them. So it will probably trigger something in the background in the IRS programs to treat a return a certain way. So you'll start seeing this in a lot of places, as you will see. Okay, due diligence. We've always had due diligence, but this is becoming a lot more important because of the get to know your clients. I'm always shocked at how many brand new preparers with brand new clients are not verifying with actual documentation. There is a lot of fraud out there. The fraudsters will try to take advantage of an inexperienced preparer. Especially if you do clients remotely, you want to be careful. You really do need to see this. Some of the new provisions for tax credits and things are going to be based on whether the person, either the taxpayer spouse and or the dependent, has a social security number valid for employment. I-10s aren't going to count anymore. However, if you do have somebody with an I-10 only, make sure you verify that as well. But with a brand new client, I get copies of this stuff. I look at the actual document. It is too easy with AI and things to have something altered that looks good when it comes across in a scan. And a real ID, for a government issued ID in particular, has holograms and other things that are pretty hard to fake. So make sure that you've got that. Make sure that you are checking birth certificates for the dependents, if they're children, and are the people really married? So again, there's some things that are going to change. There's going to be a lot more emphasis on, is it somebody with a social security number instead of an I-10? And also a lot of provisions, the married couple has to file joint. So again, I'm starting to look at these documents more closely. If I have an older, a client that I've had for a little while, I may verify on top of, what I've already done, just to make sure I'm covered for my due diligence. So we talked about there's some provisions that they must have valid social security numbers. Okay, so for child tax credit or advanced child tax credit, the taxpayer and the child must have valid SSNs. And they have to be issued before the due date of the tax return, including extensions. If you have a client that is going to get the social security number, but they don't have it by April 15th, just extend the return so that you can get the actual numbers. Otherwise, you will lose those credits, which are very valuable for your clients. So be careful about that. But no more I-10s, no more A-10s. The A-10, by the way, if you don't know, is an adoption tax ID number. If some child is in an adoption status and they don't know that the child has an SSN or not, that is what they give them temporarily. So those will no longer count for the child tax credit or advanced child tax credit. And another big change that kind of stuck in here was if you omit or have an incorrect SSN, the IRS is now allowed to treat that as a math or clerical error, and they will not need to do formal audits or anything to disallow the credit. It will just be disallowed and you're out of the picture. So be careful, be careful, be careful. This is a tricky area, but it's a lot of money for some clients. So you really want to be aware of these rules. For the other dependent credit, the big 500 bucks, just there's a little bit of relaxed rules here. The taxpayer has to have a valid SSN or I-10, and again, the due date, including extensions. The dependent can have an I-10 or A-10 or social security number, but both rules have to be qualified. They both need to be satisfied to claim the other dependent credit. I think they relaxed the rules on this just a little bit, in my own opinion, because sometimes you have another dependent credit for an elderly parent, and they may or may not have an SSN. So Told you we would go back to this. This is the dependent section on the draft Form 1040. Look at all the extra check boxes that they have added. Again, I believe it's going to make it easier for their programming behind the scenes to match up so that, yes, the person qualifies or not. I actually like this a little bit better than what we had before. But let's say you're using Drake software or whatever software, make sure you are checking those boxes in our software, because that will fill out the dependent section properly. And and again, if you have more than 4 dependents, there's special instructions. You check the box on the left-hand side, and you will probably just have another page. And again, we e-file these things usually, so the IRS can handle that. But you just need to make sure that you follow the rules. And last but not least, check if your filing status is married filing separate or head of household, and you lived apart from your spouse for the last 6 months of 2025. And there's some other special rules. So make sure if that applies, you check the box, and that if you want to take these dependents or the credits, it's going to trigger something in the IRS to double check that, of course, people, you don't want both parents claiming the dependent. There's some other things that apply. Again, it's just make sure that you're checking the boxes appropriately so that the tax return will handle the credits accurately. So again, due diligence, we all know we need to do due diligence. There are many, many, many more details to due diligence, but we tried to put it on one slide. Obviously, you need to do the 8867. You need to compute the credits, and you must have knowledge. This is the documentation, retention of records, complete it, keep the records that you kept, make your notes. Very, very important to do the due diligence and document that you've done the due diligence. You will not be happy if the IRS comes in and does not like your due diligence. They may expand their audit of your practice if that happens. Do not skimp on due diligence. It is a requirement. And we, again, in our software, we try to make it really easy with some questionnaires and things, but you must do your due diligence with any client, but particularly for credits and head of household status. Okay, fun stuff. The Form W-2. Okay, this is just the federal copy with for the employee. But what's the big change? Really nothing. But what about tips and overtime? So tips and overtime, we will probably end up seeing some codes in 2026. But for the 2025 situation, I think what we're going to see is we're going to probably get a supplemental statement with the W-2s for our clients, talking about the how much is tips, what the occupation is for the recipient, and the premium portion of the qualified overtime compensation. We probably will not see that in the W-2 itself until 2026. The 1099 NECs, again, we're starting to see a lot of these, but the big change is they're going to increase the reporting threshold to $2,000, but not until 2026. So for 2025, you're still going to see the $600 threshold. And if your client issues these, they're going to make sure that they still issue them if it's $600 or more. The good news is this $2,000 limit will be adjusted for inflation in the future years, and that's a big win. And somebody asked me, how did they come up with $2,000? If I understand it correctly, $600 when they first started these rules is now worth about $2,000 in the year 2025. So that's how they came up with the $2,000 number, which is, if you think about that, that's a little scary, but it's a big, big win for people who do issue these as well as receive these. Same thing basically for the miscellaneous. The reporting threshold is increasing for 2026. So in 2025, you're still going to see the $600 limit. 1099Ks. Okay, we're starting to get used to these, right? They've been back and forth. What's the limit? Et cetera, et cetera. It's been up and down, up and down, up and down. Let me just make a comment before we talk about the reporting thresholds. The box amount in box 1A is the total. Okay, but a lot of my clients forget that they paid fees to get this money from their credit card company or third party network. So they need to make an adjustment for that in their expenses. And a lot of people forget that. So make sure with your clients that you look for how much did you actually pay? Like maybe they got $1,000 reported, but they paid $20 fee to the issuer, the credit card company. So they want to take that as an expense. It's a legitimate expense. They didn't really get that entire amount of money, but you report the gross and then take the expenses. And in case you have a client that somehow does, maybe they accept Bitcoin or something like that through the credit card system, it's the dollar amount of the transaction on the date of the transaction. So if you have something that's based in a digital asset like Bitcoin or Ethereum or something, it's going to fluctuate based on the date, and the issuer should know that as they go. Okay, now we have a brand new Schedule 1A. I'm going to just show you on the 1040. It goes to line 13B, which is a new line. It's kind of buried under the QBI. It has nothing to do with QBI except that it might affect maybe it's really below the line. It's under the adjusted gross income line. But they had to put it somewhere, so they put it in line 13, which used to be just for QBI. So before I go on to the Schedule 1A, Amanda, do you have any questions that maybe you want me to get answered before I go on?
Thanks, Anne. I think we have one question right now about the reporting threshold for 1099K. And
Oh, you know what? I think we forgot to put the slide in.
yeah,
I apologize.
yeah.
It is $2,500 and any number of transactions for 2025, but next year it's going to revert back to the 200 or more transactions and $20,000. So here's the caveat. For the last couple years, they've been, winnowing down this threshold. And now all the reporting companies are able to do the lower thresholds. So I am not so sure that they're going to necessarily follow the new increased rule in 2026. So don't be surprised if your client still gets these in the future, even if they're under the threshold. But the threshold this year in 2025 is $2,500 and any number of transactions. Next year, it will revert back to the 200 transactions or more and the $20,000 limit. Hopefully that answers the question. Anything else before I go on?
I think we're all clear, Anne. Thank you.
Okay, great. All right, so again, Schedule 1A, it's going to flow to line 13B on the Form 1040. So let's talk about this. Okay, this is where they show the tips, the overtime, the vehicle loan interest, and the senior deduction. So again, we tried to condense what we're doing here. The no tax on tips, up to $25,000. It's available for 25 through 28. It phases out for taxpayers over a certain modified adjusted gross income. And it is only available if you have a valid social security number, and you must file joint if you are married. The no tax on overtime, very similar, up to $12,500 for each taxpayer. So if your joint returns 25 grand, that's a lot of money. It phases out again over a certain modified adjusted gross income. It is only valid once again if you have a valid social security number, and you must file joint. I always add this caveat. It is based on federal overtime rules. So some states do not conform to those rules. For example, California pays overtime if you work more than 8 hours in a day. Even if you don't work 40 hours in the week. So if you are familiar with the overtime rules, for federal, it's over 40 hours in a week. There may be differences in the premium. This is only on the overtime premium amounts, either the halftime or the double time. And again, I'm not quite sure how this is going to work for states such as California, because the overtime is different. So this will be interesting to see. If you are in a state where overtime is calculated differently, please watch your state guidelines. They may or may not just say, we'll take the federal number as gospel, or whatever's on the W-2 reported as gospel. But technically speaking, California would in effect pay more in overtime than the federal would. So again, I don't know how they're going to I don't know what they're going to do with that, frankly. So just keep an eye out for your tax updates and see what they're doing. The deduction for vehicle loan interest up to $10,000 a year, again, only available 2025 through 2028. It has a phase out. Only certain vehicles and loans apply. The loan has to be initiated in 25. This one, I'm not so sure we're going to see a lot of activity on, but if you deal with car dealers, believe me, they're going to be up on this thing because they want to sell cars. And by the way, today's the last day for electric vehicle credits, so it's pretty busy at the dealers by me in California, getting rid of all those electric vehicles and alternative fuel vehicles. So, and last but not least, on the 1A, the enhanced senior deduction up to $6,000 for a taxpayer plus their spouse, so up to $12,000 on a joint. They must have a valid social, and there is a phase out. But you might be surprised how well this helps some of your clients. This was the deduction that was supposed to cover, oh, no tax on Social Security. There is tax on Social Security. However, this additional senior deduction may get them out of it. But even if your client is 65 and over and they do not collect Social Security, they still get this. So this is a win for a lot of the older clients I have in my practice, at least. So here's the form itself. Again, this is draft. So the first part one, basically this is the modified AGI that you use to calculate how much is valid for tips, overtime, and car loan interest, and the senior deduction. So it's basically AGI with any excluded foreign income added back, which probably is a pretty fair thing to do. The no tax on tips part, again, it's only available for 25 through 28. And you can see how you go through the calculations on this. It will walk you through, talk about the AGI limits, etc. It may limit how much they get, but it's pretty straightforward. Part number 3 is for the overtime. And again, this is a brand new code section in the Internal Revenue Code. Again, 25 through 28, and it'll walk you through the calculations. And again, don't forget the overtime is based on federal rules. And then the no tax on car loan interest, part 4, it's going to ask for the VIN. So again, if there's special rules, there is a chart to look it up, which VIN number qualifies, but believe me, the car dealers will know. They're selling the new car and this is a sales point for them. This deduction does expire. So at the end of 28. And last but not least, last 2 parts of 1A, the deduction for enhanced deduction for seniors. This is where they put it. And they do the calculations with the modified AGI. And then the very last part 6 is going to carry to the Form 1040 line 13B. So pretty straightforward calculations on the form. They couldn't squeeze it in anywhere else, so they just made a whole new form. So lucky us, makes it easier. Okay, and before I go to standard deduction, any questions maybe, Amanda, on the Schedule 1A since it's brand new?
Okay, yes, sure. Someone named Anne asked, the married filing joint limit of 25,000, do both spouses have to have tips?
No, just if
Okay.
one has tips, but I believe it's per taxpayer. So the taxpayer who doesn't have tips is not going to make it be the double. Like it's only for the person who's actually getting tips. Each taxpayer gets that
Okay.
12,500.
So not 25,000 for one person if you're married.
Right.
Okay.
Exactly. Right. Right. Okay. Any other
Thank you.
questions, or are we good?
Let's see. Jacqueline says each spouse can qualify for the 6,000.
Yes.
Yeah. Okay.
Yes. Mhm.
Okay,
And
thank you.
like I said, that one when I've been doing my tax planning recently, I'm actually pleasantly surprised at how this has helped out some clients. This is a good one for my older clients. And I say older, 65 to me isn't old, but it qualifies them for a lot of stuff, including discounts at the restaurants, right? So okay, let's go on. We've got a standard deduction. Okay, got a little chart here. One of the first bonus wins was the standard deductions under Tax Cut and Jobs Act, were set to be a certain amount, and they immediately raised all those amounts. I forget exactly how much it was, but it was something. So the 25 standard deduction is actually on this column right here is actually bigger than what it was supposed to be. So a lot of softwares have already a calculator for that. It helps your clients a little bit. Great. The old rules, as you can see, it was 14,600 for an individual. Now it's more than $1,150 more. So that's great. That's a win. The additional standard deductions, we had like for 65 and blind and things like that. And then we have the new senior deduction. And then, of course, it's a dependent standard deduction. If you have a dependent who has unearned income, there's going to be some special rules for those returns. This is just kind of a summary chart. Most software companies I know have already incorporated this, including Drake. So, wow, we're running through this stuff. So remember I mentioned there's a lot of other miscellaneous provisions in OB3. I'm just going to touch on a few of them. There are a lot that, like I said, I'm not considering them tax per se, that were put in here. We're not covering those today, but there's actually quite a few. And again, I apologize for something here. We didn't really put in a slide for the itemized, I just realized. What's the big one? State and local tax deduction is now going to be $40,000 instead of 10. That has really made a difference for my California clients. But there is a phase out once the AGI gets to a certain point. I apologize, for some reason, I just realized we don't have a slide for that. That's probably the biggest change is the state and local tax deduction. There are some changes for charitable. Again, we don't have a slide for this, I apologize. The charitable deductions are going to be limited. There's going to be like a 0.5% haircut for people who itemize for that. And then it's going to be above the line deduction for charitable I think it's going to go to 1,000 per taxpayer. So $2,000 for a joint. That's going to be above the line, even if they take the standard deduction. So that's going to really help for those people who are very philanthropic and give money each year, but they don't itemize their returns. So look for those. And again, I apologize. We did not have a slide for that. We should have. But this is a Washington Post chart that I used from back in July. It's actually really, really handy for me to kind of eyeball it because some of the credits, like we were talking about the electric vehicle credits and the green home credits, some of those are ending in the middle of the year. Like I said, today's the last day for the EV credits. So if your client if they want to get that electric vehicle credit, they need to buy that car today or have already bought it this year. The other things like we've talked about, the SALT increase, there's some things that expire basically at the end of 28. And the non-tax things, there's going to be some stricter work requirements for the food programs and Medicaid. There's Medicaid funding changes, of course, that are going on right now. Who knows? I haven't looked at the news in the last couple hours. I don't know if they've done the funding bill or not, if there's going to be a shutdown tonight. But there are some changes coming for those programs. And then the student loans, there's some changes to those. The repayment programs in some cases are ending where they were allowed to defer. The parent loans are going to get limited, and apparently they're not going to allow plus loans for graduate programs anymore. So again, that's not really tax per se, but there are so many other provisions that may affect your clients or your tax business. So refunds, payments, and rates. The far right column, I think we've already talked about this. The big news was the tax rates from the Tax Cut and Jobs Act. Again, this is the right column. These have been extended permanently. So this is a win. This is lower tax rates. This is always good. But you and I both know permanently in the government is relative term. So we'll take it for now. Right now, we're getting these through 2028, 2029. Let's see, it would take a congressional change to change these. So we've got a little safety net. Why am I concerned about these rates being extended? Because my clients, a lot of them are getting to the point where they might want to do some Roth conversions before they take Social Security, after they retire, but before they take Social Security, to convert these pre-tax 401ks and things like that. They want the rates to be low. We have the rates for maybe capital gains, interest, things like that, qualified dividends, big deal. So again, we'll have a little bit more breathing room planning for these clients because the rates are going to stay around for a while. But let's talk about refunds and payments. You may or may not know, but you can refund up to 3 banks, including IRAs. So this is something that a lot of people don't do for their clients. But if you have a client that wants to fund their IRA, they can take their refund and do it. So I'm sure, I know our software does it. Obviously the forums do it. But that might be a way for your client to do their retirement. They don't have the money in pocket, but they can use their refund to fund their Roth or their regular traditional IRA. Paper checks, back and forth. I'm pretty sure that's going away. There's still a little bit of confusion on this, but as far as I've been seeing in my sources, your clients will have to accept some kind of direct deposit, and they will have to make any estimated tax payments or balance dues on their return with an electronic method. So again, most of us have already set up direct deposit or direct refund. But if you have an unbanked or underbanked client, I actually have some of these. What I do with those, if they have a Social Security income, they have usually a Direct Express card. You can get the information for direct deposit to that card, and that's how we do it. Or if they owe money, we can pay it from that card. So that might be a way for at least your clients who are getting some kind of government payment. They probably have a Direct Express card, and that's how they can do it. But that's going to be a real tricky thing when your clients owe money. There are some clients, I still have them, and they want to write a check and mail it, which I discourage, but it's still up to them how they want to do it. So again, we're just going to have to work with the clients who are in this situation and figure it out. Okay, gambling losses. Again, this is kind of a mismatch of various things. The OB3 limits gambling deductions to 90% of the losses, and then they can only take that loss up to the extent of the gambling gains, the winnings. So if you have a professional gambler, this may really affect them, but it doesn't mean that if you're a professional gambler, in a simplified thing, had $100,000 of winnings and $100,000 of losses, well, they can only take 90% of the losses. So what's going to happen? They're going to get 100 winnings minus 90,000 of losses. They're going to show some income, right? But let's say their losses were 150,000. Well, 90% of that is more than the $100,000 of winnings. So they will be able to break even in that situation. So again, some planning there. Depreciation. Okay, bonus depreciation and 179. Big increases. The 100% expensing bonus is made permanent. And again, great for planning. There's some reduced percentages in 2025 for the bonus. Not all states do bonus. So, figure that out for your clients, whether it makes sense to do the bonus or not. But what's the intention here? The intention is when they want people to build their manufacturing, etc. in the United States, we're going to give them a great incentive to do so. Schedule C, QBI. And this is not just Schedule C, by the way. This is any QBI, but the one at the bottom is the new one. But basically, QBI is now permanent. Yay, another win. And you can still use the same methods. There's some behind the scenes, there's some increased thresholds and phase outs. So that was also a win. But if you have a small Schedule C side business client, this last bullet point is a big one. Maybe they just sell stuff on Etsy or something like that. Well, they can get a minimum $400 deduction. This is a win because it's going to reduce their tax bill. And that's always a good thing. I'm thinking of, again, mostly like I have clients that maybe have a side business like dog walking, or maybe selling something on the online, or maybe they're starting their business. This is a win. Not a lot of money, but it could be for that client. So that's new. That's brand new. Okay. Okay, Kiddie tax. Okay. Really no changes, except of course, every year the threshold goes up. But on the Form 1040, line 3C and line 7B, notice there's a checkbox if your child's dividends or child's capital gain or loss are in these numbers on your return. Why are they doing it? Again, I really believe they're reprogramming behind the scenes so they can match and, get a lot easier for them to process their returns through the computer rather than, and their algorithms, rather than trying to have a human look at it. But this is new on the Form 1040. It doesn't really change the Kiddie tax per se. All right, digital assets. Before I go to this, any questions, Amanda?
Yes, thank you. We had a couple of questions back on the slide when you were discussing the succession of the paper checks and refunds to IRA. So the questions we're getting is, if you refund to an IRA, which year does it count for, the current year, the current or the tax return year? And what happens if the refund isn't until after April 15th?
Okay, if it's after April 15th, it would have to be for the next tax year, but really the way it works for the refund going into your IRA, it should be for the prior tax year. So you need to do it by April 15th. I don't think there's an easy way to make it go for the future. You probably could, but most of the time I see that it's defaulting to the prior year. Now, here's a caveat. When I do this, I have it go to the prior year, and sometimes the custodian messes it up. So you got to check and make sure they put it to the right year.
Right, that's good advice.
Yeah.
Thank you.
Okay. Anything else before I
No,
go
I
on?
think we're good from there.
Okay. All right. So Kiddie tax. Okay. Digital assets. Woohoo. My favorite topic. In the various classes we've had this year, I've always, we always have been asking the question the last couple of years, how many people are doing returns with digital asset transactions? And of course, every year the hands go up more and more. Many people are going into those. But what's the problem? There's no consistent reporting. These, by the way, are the questions that, and the bottom one for 2025 is still technically draft, but the question hasn't changed since 23. But it has changed over the years, just as a reminder. But if they check, yes, you probably have something you need to report on the return. That's the bottom line here. I do advise tax preparers to ask a lot more questions because they don't know what they don't know. But just like we had with the 1099-Ks, clients walked in a couple years ago and you were like, well, what's this for? And they say, oh, I sell stuff on Etsy, or I rent a room in my house. And you never knew it because they never got a piece of paper, so they didn't think it was taxable, right? So then you had a decision to make. How do you handle the prior stuff? And of course, now you have something on the current return. Well, we're going to see that again with this new form, the 1099-DA. You've had clients that have been saying, nope, I don't have anything reportable. And if you don't know your client well enough, or you haven't asked enough questions, maybe they have been doing stuff with digital assets that were a taxable transaction, but they didn't know it. And now they're going to start getting these 1099 DA forms. And so you're going to have a decision to make and a process to decide on. If there was something in the prior year, obviously the correct thing is to amend the return. But do they have the basis? Do they have all the transactions in a format that you can use, etc.? So again, I'm just posing that question kind of rhetorically because you will have to come up with an answer for your practice. But for 2025, this form has been in process for a couple of years, but now they finally made their decision. It is going to be issued in 25. It is a form required for each transaction. Now, when that scares you, it should, but technically a 1099-B transaction and things like for stock sales and things, you were supposed to get one for each transaction, right? But the brokers like Vanguard, Merrill Lynch, or whatever, they came up with the substitute forms, and the IRS said, okay, and so you might have hundreds of transactions, but then there's a summary by each set, like covered, non-covered, short-term, long-term, etc. I suspect that we will start seeing those for the 1099 DA transactions as well. Maybe not this year, but we will probably see something like that in the future as these become more and more actively traded. But for 2025, only the gross proceeds are required to be reported. So have fun with your clients getting the basis for these transactions. I strongly suggest, if you do not already have a relationship with some kind of accounting software for this, that you get one. There are companies out there that will help people who do a lot of these transactions consolidate and look over their different exchanges and wallets and things, and they will come up with a good reporting. Do not wait until April 1st. You will not get the information from any of those companies because they are quite busy. But I strongly suggest you learn, link up, hook up with one of these kind of companies. I cannot give you names, but there are a couple really good ones out there. Also, in January 26th, then the brokers must report both proceeds and basis for covered securities. Remember, we have in the financial assets covered and non-covered, and those it's going to work similarly, because starting in 26, they're going to have to track the basis for you. Before that, it was voluntary. Somebody like Coinbase, big company, they may or may not have the basis already. And for right now, only the exchanges have to do these forms. The places that are what they call DeFis and things don't necessarily have to yet. I really hope they get required to do that. If you have clients who do those kind of transactions, make sure you're starting to talk to them now. So here's the form. Quite a bit of information on it. And if they get this form, the answer is always yes on the form 1040. And if they answer yes, you have something to report. That's basically the golden rule. I try to think of an example. It would be maybe if they made a mistake on the reporting side, but I find that unlikely. So just get familiar with this form. This is the 2025 version. Okay. Watch out for whether they've reported gross or net proceeds. That's going to be a big deal. Again, if the basis was reported, yes or no, etc. These are treated like property, and currently wash sale rules do not apply. I expect that to change. Okay, disaster and casualty losses. The main thing here, I'm going to watch my time, is the bottom bucket. This will allow deductions for personal casualty losses if there's a federally declared disaster or a state declared disaster. This is a huge win for some states where the federal government didn't say yes, it was a federal disaster, and that because it makes something eligible for a lot of extra federal aid. Now if the state governor declared the disaster, you can get the deduction. This is a huge win. Okay, so we almost are on our 50-minute mark. Any questions that we can start answering, Amanda, and then we can go over the housekeeping?
Yeah, I think that I answered most questions. I think if anyone else has any outstanding questions, to drop them in the Q&A right now. There were some questions, I can go back to some that I think I answered. When we were talking about the no tax on overtime, there was a little bit of confusion in the guidance as what portion of the overtime was actually exclude or deductible? Is it the just the 0.5%, like if
Yes,
you're getting 1.5%, or is it the half
it's
or the one and
just
a
the
half?
premium. It's just the premium.
Okay.
So as far as I understand it, the big companies, payroll
Mhm.
companies like Paychex, ADP, they are able to separate the premium. So they're going to be able to give, reports. If you have a smaller payroll provider, you're going to have to figure that out.
Yeah.
And most of my time in industry, the time and a half and double time was always reported separately anyway. So
Yeah.
it might be easy to calculate that. One of the things I'm asking my clients for this year is their year-end pay stubs.
Right. Yeah. A lot of people were asking, like, is there going to be a new field in the W-2? I think that's really smart that you suggested that, because I think that's where they're going to get that information.
Yeah. Yeah. And I think
Um,
the W-2s, they're going to issue like some kind of, supplemental sheet because
yeah.
they know this is a transition year. Right.
Right. Another question, I see a question now from John, and there have been other questions about the used vehicle interest deduction. And someone else asked, does it need to be, made in the US? I know that there's a
Yes,
laundry list of
there is. There
requirements.
is.
And
Big time.
John
Big
asked,
time.
does it have to be a brand new vehicle to qualify?
Um, there is apparently um some
Yeah.
exception for refinancing. I don't want to
Oh,
say absolutely, but the
yeah.
vehicle still has to qualify like it would have if
Yeah.
it was bought this year. But if you
Yeah.
have a loan and you refinance that loan on that vehicle in 25, supposedly
Yeah.
there's an exception. I would definitely check the regulations before you do that.
Yeah. What I
Um,
read too aligns with that, because it says the taxpayer has to be like the original owner, and a
Absolutely.
refinance would still,
Very good.
yeah,
Yes,
that
thank you
that
for
makes sense.
clarifying that. That is true.
Yeah, yeah. So yeah, I always recommend checking too, but makes sense to me. I know that there is about 6 or 7 different provisions there for that. So I always like to see it in writing too. So
Right. Right.
looking that up would be a great follow up. And I think that that's everything we have for our questions today. Oh, we have one more. We'll answer this one real quickly. This is from James. IRA payments are allowed for a taxable year, including the extension. If a client received a refund, why would the IRA deduction not be allowed? So as long as the refund was deposited prior to the extension deadline.
Okay, that one I'm gonna have to actually look up. I do not want to quote when I'm not absolutely certain.
You don't know everything on the top of your head, Ann?
Yeah, no, not now, not lately. I mean, we use
I
AI for
know.
our tax research too, right? So,
Yeah.
but actually that's a good one. Now,
Yeah.
here's the reality. Most people don't fund their IRAs this way.
I
I mean, but if you do have that kind of client, it's a great way to make them do it. Um,
right. Yeah.
and speaking of that, that's something else I want to do. I do want to mention, just like one of those, let me go back to the end here. One of the uh things that, they didn't change the withholding tables. They didn't change some other things. So, next spring, a lot of people are going to get bigger refunds than they have been getting because
Mhm.
their taxes actually went down, but their withholding did not go down accordingly. Because most people I know are not
Yeah.
changing their withholdings. So be aware of that in the spring because when they go, wow, well, that's great, but the withholding tables in 26 are going to be adjusted.
Yeah. Yeah,
So
that's
you don't want your client to get used to these big refunds.
yeah, and that was a tough one for clients to understand for
Yeah,
sure. Yeah.
yeah,
Well, thank you so much, Anne. I'm so happy to have been here with for this presentation. You did such a
yeah.
thoughtful overview of such a complex new tax act. And I know that we are all still wrapping our heads around the OB3.
Oh,
So, and I appreciate all of you who joined us today. We hope we hope that this session brought value to you. If you're interested in signing up for further webinars, CPE, seminar offerings, there's some links in the chat today that you can use to sign up for those. This Thursday, though, we'll also have another business success webinar. It is called Before the Rush, Smart Tax Moves for Tax Software and Pre-Season Success. So we're going to talk all about tax software and how to get ready for tax season. And once again, I want to remind everyone that you'll receive an email tomorrow with a link to this recording. And if you're a Drake software customer and you haven't renewed, we encourage you to renew now while we still have some early renewal discounts for our unlimited packages. And you can do that at drakesoftware.com/renew. If you're not a Drake software customer, we'd love to chat. So reach out to us at drakesoftware.com. And with that, I think I'll close this out. Thank you for joining us, and I hope everyone has a great day. Thank you.
thank you, everyone.
Thank you.